Will the S&P 500 endure a massive 0.1% lost decade collapse? You know that uneasy feeling you get when you're at a party that's been going great all night, but then someone suddenly says, "I think this might be the last song." That's kind of what's happening on Wall Street right now. After one of the strongest bull runs in history, investors, analysts, and economists are starting to whisper something that feels almost heretical. What if the US stock market is heading into a lost decade? Yep, you heard that right. 10 long years of basically going nowhere. Welcome to L-Impact Solutions Podcast, where we break down business and financial trends that actually matter to you. I'm your host, and today we're diving deep into one of the hottest, and honestly scariest, topics on Wall Street. The growing fear that after years of record-breaking highs, US stocks could flatline for the next decade. Whether you're an investor, a business owner, or just someone curious about where your retirement account is headed, this episode will hit close to home. So, let's start with what's got everyone talking. The S&P 500, America's most watched stock index, is currently trading at a price-to-earnings ratio around 27. That's well above its 5-year average range of 19.5 to 25.4, according to data from World PE Ratio. In plain English, that means stocks are expensive, really expensive. And when prices get too far ahead of actual earnings, history tells us the market tends to slow down, or sometimes fall back to earth entirely. And here's what's wild. Even with all this anxiety, the market is still climbing. Just last Thursday, both the S&P 500 and the Dow Jones hit fresh record highs. Investors reacted to Oracle's earnings, shuffled out of some tech names, and poured their money into other sectors. The party's still going, but some of the smartest people in the room are starting to check their watches. So why are analysts using the phrase lost decade? It comes from the idea that sometimes markets don't crash dramatically. They just stop delivering real returns for a long time. Think of Japan in the 1990s. Stocks didn't implode overnight. They just drifted. For American investors, that's an almost unthinkable scenario because we've gotten used to the market bouncing back from every dip, pandemic, inflation, rate hikes, you name it. But what if this time, the bounce doesn't come? Let's put some numbers behind that fear. According to Bank of America, the S&P 500 could actually lose 0.1% over the next decade. You heard that right, a negative return. Compare that with the historical average of about 10.5% a year since the 1950s, and suddenly that lost decade label starts to make sense. That's like running a marathon and discovering you've been running in place the whole time. Bank of America points to two factors fueling this gloomy forecast. First, those sky-high valuations we just mentioned. And second, the simple exhaustion of an aging bull market. The S&P 500 has surged more than 90% since its 2022 lows when we were all still recovering from the bear market that followed pandemic-era disruptions. Stretch that timeline out even further, and you'll see that the US has been in a secular bull trend since 2009, basically one long ascent after the great financial crisis. So if you're counting, that's nearly 15 years of upward momentum. No wonder the idea of slowing down feels so foreign. But markets can't defy gravity forever. Eventually, valuations, interest rates, and global competition start tugging them back to reality. And that's where this conversation gets really interesting. Torsten Slok, the chief economist at Apollo, recently said he expects the S&P 500 to remain relatively flat for the next 10 years based on its current forward price-to-earnings ratio. Essentially, his argument is that when stocks are already pricing in years of future profits, there's not much room left for surprises or growth. Now, let's pause for a second and look at how we got here. Over the past few years, American companies, especially in tech, have fueled an enormous amount of wealth creation. Think of the AI boom, the cloud expansion, and the unstoppable growth of companies like NVIDIA, Apple, and Microsoft. Those success stories lifted not just their own stocks, but pretty much the entire market. Add that to low interest rates and massive liquidity injections during the pandemic, and you've got a recipe for an epic rally. But as every investor knows, growth creates expectations. Expectations drive valuations. And high valuations eventually lead to disappointment, because the higher you climb, the harder it is to keep rising without slipping. That's exactly what's making analysts nervous. They're not saying the sky is falling. They're saying the ceiling might be closer than we think. Let me give you a quick analogy. Imagine you're running a business, and every year, your profits double. Investors love you. They start paying more and more for each share of your company. But at some point, it becomes impossible to keep doubling. Maybe your market is saturated, or your costs go up, or competition heats up. The moment that happens, the excitement fades. The price investors are willing to pay starts to level off. That's the story Wall Street is wrestling with today. A story of expectations finally catching up to reality. Now, let's talk about the psychology at play here. The US market has become something of a global symbol of resilience. Every time the world throws it a curveball, whether it's the dot-com bust, the 2008 crisis, or COVID, it finds a way to bounce back stronger. That mindset breeds confidence, but it can also breed complacency. When everyone assumes the next 10 years will look like the last 10, that's when corrections happen. Remember that Bank of America note I mentioned earlier? They did some fascinating math on this. Historically, when the S&P 500 experiences 3 consecutive years of over 15% growth, like we just had, the returns that follow are, on average, 2.3 percentage points lower than usual. Basically, after years of feasting, the market tends to need a diet. But not everyone is convinced this lost decade prediction will come true. Some optimists argue that innovation could keep driving growth, even if valuations seem stretched. Artificial intelligence, clean energy tech, and biotech breakthroughs could ignite new waves of productivity and profitability. If history tells us anything, it's that innovation has a way of rewriting the rules just when we think we've reached a limit. However, there's also a global angle to consider. If US stocks go flat, where does the growth happen? Some analysts suggest that international markets, especially emerging ones, could finally have their moment in the spotlight. After all, many global equities trade at far cheaper valuations than their US counterparts. In other words, the lost decade for American stocks might be the found decade for the rest of the world. Still, we can't ignore the impact that US financial trends have on everyone else. The American stock market isn't just a national indicator, it's the engine of global finance. Pension funds, sovereign wealth funds, and everyday investors around the world have skin in this game. If the US enters a decade-long stagnation, the ripple effects could touch everything from bond yields to currency exchange rates to how tech companies raise capital. Now, what would a lost decade actually feel like for everyday investors? It probably wouldn't look like a crash. It would look more like slow frustration, returns that barely keep up with inflation, corporate profits that rise modestly, and a market that moves sideways despite all the hype. Dividend yields would matter again. Stock pickers might come back into vogue. And passive index investors, the ones who've made a killing for the past decade, might need to rethink their strategies. This idea that you can't just set and forget your portfolio might be making a comeback. Instead, investors could have to get more tactical, embracing international diversification, sector rotation, and even alternative assets like private equity or real estate. In other words, the next decade might be one that rewards adaptability rather than blind faith in the market's long-term upward drift. One detail that stands out here is how valuations are being interpreted differently today than before. We live in an era when tech dominance and AI potential make it tempting to say, well, this time is different. Maybe those companies really are worth their lofty multiples because they're shaping entire industries and future economies. But the phrase, "this time is different," has historically been a dangerous one in finance. It's often what people say right before reality sets in. So, if this prediction of a lost decade does play out, what's the smart move? First, it's not about panic, it's about preparation. If you're a long-term investor, this could be a good time to revisit diversification, balance your exposure beyond US equities, and maybe look for undervalued opportunities globally. For businesses, it's a reminder that high earnings and stock buybacks aren't the only route to growth. Innovation and operational resilience will matter even more. For policymakers, the prospect of stagnant equity returns could also raise big questions. How do you sustain consumer confidence and economic momentum if the wealth effect softens? When people don't see their portfolios growing, spending habits can shift. That in turn affects corporate revenues, job creation, and fiscal policy decisions. Ultimately, whether or not the U.S. truly enters a lost decade, this conversation forces all of us, investors, institutions, and policymakers alike, to think differently about what growth means. Maybe we've grown too accustomed to double-digit annual returns. Maybe a period of slower, steadier performance isn't such a disaster. It might even be healthy. Like an athlete taking a recovery season between championships, the U.S. market could simply be recharging for its next big leap forward. Still, uncertainty always makes people uneasy. And that's the delicate balance right now, between optimism about innovation and realism about valuations. Between the story we want to believe, that American markets always win, and the numbers quietly hinting that they might take a breather. So, here's where I'll leave you today. If Wall Street's predictions of a lost decade come true, how do you think it will reshape the investing mindset? Will people become more cautious and global, or will new forms of innovation keep the American stock market's edge alive? I'd love to hear your thoughts. Drop your answer in the comments, and let's keep this conversation going.